So Amazon, one of the very few stocks in the market that every dip's a buying opportunity. One of the very few stocks. There aren't that many stocks in the market that it's like every dip you ever get, any major dip you get in that stock, you take advantage, throw it in the filing cabinet and forget about it. Amazon's one of the very few companies. When you look at like how much growth still the e-commerce business has. Like when does the e-commerce business stop growing? 15, 20, 30, 50 years from now? Like I don't even know. It's so long in the future. Like it might be past my lifetime, to be honest, right? Like that's insane. AWS is still earlier innings in this game. I don't know if that's a third inning game or a fifth inning, but we're still in the earlier innings of AWS. That still has so much growth ahead of it over the coming years, right? The advertising business, obviously, right? They're spending a fortune on tech right now in Amazon Prime and things like that, which we'll see how that pays off over time. But obviously, they're very focused on spending there. And they just have the right DNA at that company to focus on the next big opportunities and focus on the long term, which is something I just appreciate in a massive way. And so Amazon's one of the very few stocks that every dip's a buy. Every single dip's a buy. And, it's hard to go wrong in that one over a 3, 5, 10-year span, and so I expect to make very nice returns in that one over time. I might even do a video going into all my Amazon projections over the next 5 years. If you're interested in something like that, let me know in the comments section. I can maybe do something like that on the main channel, or even this channel, maybe even potentially, where I go into all my projections for my ultra bearish case, my bearish case, my base case, my bull case, and my ultra bull case over the next 5 years. So yeah, let me know if you're interested in something like that. Something I heard on the conference call that I loved was and this goes into the long-term thinking mindset, right, is Andy Jassy and the team, they were talking about how they focus on customer relationships that are going to last way beyond their time period at the company. And so it's such a refreshing thing to hear because I'm telling you, like, 98% of executives out there are they're just focused on whatever's happening in the very, very short term because they're not going to be at that company. They don't really care about it long term. But Bezos has such a long-term focus at that company, and he's done such an amazing job of instilling in the culture. And who knows if that'll still be the culture of Amazon 20, 30 years from now. But it is today that they're focused on client relationships that go way beyond their time period at the company. Andy Jassy, who knows? Is he going to be at the company 3 more years, 5 more years, 10 more years? I don't know. But he's focused on building such strong customer relationships that last way beyond his tenure at the company. And that's something I just find so refreshing. It just makes me such a happy shareholder and such a happy person to be buying the stock this entire year. Because I just look at it, I'm just like, that's the mentality I need in a company. Somebody that's really focused on the long-term game here and not just focused on trying to grab whatever they can from, their customers of AWS right now. They're working with their customers to bring down costs as low as possible right now. And it hurts them in the short term as far as their revenue growth, but it helps them massively long term, building actually sustainable, great relationships. And their customers won't forget that. And so these are just things I think about that I think are very impactful and matter in a significant way. Doing your customers right like that, by doing your clients right, makes it much less probable they're going to go somewhere else and do something else, right? It's like you go to the pizza restaurant, your favorite pizza restaurant, and they mess up your pizza. They could just say, tough. Or they could just make you a whole new pizza, right? And keep you as a customer. If they say tough, well, I don't know. That might not be your favorite pizza spot anymore. You might go somewhere else, right? This is business, man. Business is a simple game. Keep your customers happy. Do right by your customers, and you'll be rewarded over time. It's always been that way. It always will be that way. If the Fed cuts rates, okay, in whether that's, a month from now, 3 months from now, 6 months from now, that changes a lot for the stock market. Obviously, it can change things even for the economy because you could talk about lower interest rates and all those sorts of things. But just on the stock market side, they can change things pretty drastically. Right now, the Fed funds rate's roughly 5%, okay? Let's just say, hypothetically, the Fed cut to 0. That's not happening, certainly not right now. But let's just say that for whatever reason, they cut to 0 right now, okay? Immediately, the stock market would have to go up in a dramatic fashion because suddenly you are, when it comes to doing your DCF models and whatnot, you're not having to divide out by a 5% interest rate now at this point in time. It would be basically a 0% interest rate, or if they went down to 1% or something like that. And so which means what you're willing to pay for a risk asset is going to be exponentially more if you're in a market in which, let's say the Fed funds rate's at, 1% versus a Fed funds rate at 5% or 7% or 10% for that matter, right? And also just think about it on a, that's more of a high level view, but just think about it on a common sense view, right? Think about this on a common sense view. If suddenly Fed funds rate was 7%, let's say, for instance, right? Well, that means you're going to be able to get likely on savings accounts, CD accounts, even potentially treasuries, you're going to be able to get guaranteed money at 7%ish, somewhere around there roughly, right? 6 to 8%. And so a lot of people would look at that and say, well, why do I need to be in the market if I'm going to get 8% in the market and take risk versus get 8% from something from the government that's guaranteed, or a savings account that's FDIC insured, something like that, right? And so that can obviously change valuations. That's one of the things that I don't think is being talked about enough in this market right now. People are not talking about, if the Fed cuts rates, that means you're going to be willing to pay more for stocks. So even if the economy was to get worse, even if earnings were to get a little worse, if suddenly you're at a 1% Fed funds rate versus a 5%, you're willing to pay a lot more for that asset. And so that's just something that I don't think is talked about nearly enough. That's one of the many reasons why the market bottomed in early 2009 and then started to move up despite the economy not being in a good place. The economy was not in a good place for several years after the stock market bottomed in around February, March of 2009. But yet the market was moving up. One reason was earnings started to get better at the very end of 2009 and going into 2010. But another component was you went from a Fed funds rate that was, let's say high threes, maybe around 4% or so in around 2007 to next thing you know, Fed funds was at basically zero by the beginning of 2009. And so nonetheless, you're willing to pay a lot more for a risk asset. So this is just something that I don't think is talked about nearly enough out there, but it should be talked about more. And I can guarantee you, in big money circles, this is something they're conversating about. Now, the next thing I want to show you here is investor sentiment. So this is from our investor report. We put it out in the Private Stock Group, the Private Wealth Group, each and every week. By the way, if you're looking to join us in there and apply to join us in there, check out the description area. That will be for an application to join us in there, okay? But one of the slides we put out in this report each week is the AI investor sentiment, right? And so it's a little less bullish than it was last week. Bullish numbers come in at 24.1% of investors are bullish on the market the next 6 months versus last week was 27.2%, right? More folks have moved to the bearish side. So bearish side collected almost all those moves down there. Bearish side's up to 38.5. So the bears are feeling more confident. Why do I think the bears are feeling more confident? I think the bears are feeling more confident because of earnings. But from the context of somebody like a UPS, not from the context of somebody like a Meta, I think I think bears are looking at something like UPS numbers being down 6%, if I recall, revenue-wise, and looking at that and saying, oh, what's going on with this economy? Okay. And so that's my opinion from the bearish side, why some of those is, they're looking at some of those companies and maybe they looked at Whirlpool numbers, which is obviously a huge appliance company, not in a good place right now. And so I think from that standpoint, you could also look at, what was it? I think it was Century Communities we looked at recently, right? And if I recall, Century Communities' backlog was down, oh gosh, what was their backlog down? Like 60% or something insane like that? When you see things like that, I think naturally it makes folks a little more bearish about kind of what the future holds here. And then you tack on that mortgage rates are really high right now. 30-year current rate, 6.4%, folks, okay? It doesn't look like this is going to be a good spring for real estate. And this really needed to be a good spring for real estate because we've kind of been in obviously a pretty weak real estate market for a bit here, right? And home builder confidence is not in a good place. I showed this yesterday, I think on the reaction channel. Everybody talks about, the home builders are, they're doing so well and they got a lot of orders coming in and, low inventories helping out these home builders and they spin it so positive. But then you dig a little deeper and you say, wait a minute, home builder confidence has crashed. Year over year. Home builder confidence is down 41.56% from a year ago. That shows you that the home builders are not feeling so great about the futures of their business. The fact is, if home builders were feeling great about the future of their businesses, this number would not be down 41% on a year-over-year basis. It would be positive on a year-over-year basis, or at least flat. This is a disaster, folks. Okay, and so I think that's another reason. You look at the NASDAQ top 10 stocks. I mean, my gosh, Meta is leading the pack to the upside here, right? And, I heard somebody saying, take profits in a stock like Meta. And it's like, well, what for? You could, but what for? You know what I mean? Like Meta's still trading at a forward P in the 20s right now for a company that should be in the 30s for a forward P basis. So why would you take profits in something like a Meta? Because it could go down to forward P at 15. It doesn't make sense when they're likely going to increase their EPS double digits and probably, very higher double digits, I would say, over this next, I would say, 4 to 6 quarters here. So why would you do something like that? Doesn't make a whole heck of a lot of sense, to be quite frank, to take profits on something like that. So yeah, we got obviously a big week ahead, upcoming earnings. Obviously, Apple's the big dog. That's the one that, if you want to talk about messing up the market or not, it's going to be Apple there, folks. It's going to be a very, very important one. AMD is going to be important as well. Do keep that in mind. There's a few other stocks out there. So